So welcome everybody to our first quarterly WPS provider audit update webinar. So this is something we have been talking about internally for a while. We wanted to get a chance to bring up some new issues, new audit related issues to our providers. We have a chance every now and then to speak at various HFMA conferences, but that doesn't reach every single provider, and it's kind of spread out throughout the time when we happen to be talking at those meetings. So basically we decided let's go ahead and set up our own little quarterly updates. So we'll be posting these to the WPS Learning Center each quarter, right around this time of the month, basically just a week to 2 weeks after the end of a quarter. So keep an eye out for those as they come up, and again we'll follow the same basic process. We'll send that out. We'll use WebEx, send out an email reminder, things like that. So this presentation, the slide set, was developed by Paul Hula, Ron Wolf, and myself, Chris Everson. I'll be presenting these slides to you today. The slide, if you haven't already looked at the email, the slideshow is in that email. There were just a couple of minor changes I made to that with some of the S10 numbers, but other than that, it's the same as the one you see in that email. We'll be doing that. And one thing about the questions, one thing I want to mention here is if you do happen to have any questions, you can feel free to post them to the chat area. I will keep an eye on that as we're going throughout the session. Some of the questions I might be able to answer right away. Some of them I might need to wait till the end, or possibly even perform further research and get back to you. And yeah, I see we have a question. Yeah, there are some of those beeps when people join. Unfortunately, that's something I can't change on the fly here. Let's see. Yeah, I can't really change that on the fly, but I'll keep an eye on that, see if I can do that for future sessions there. So hopefully that'll die down in just a little bit. But again, feel free to post those questions here. For the agenda, I also sent out the agenda Word document in that email as well with a little more detail. This is just a brief listing of the things we're going to go through. We've already kind of talked about the introduction. We're going to be going through some new cost report acceptability requirements that you may very well be aware of already. We're just going to go through them because now there's a change. There's an actual change request that makes them effective for us to actually review for that at acceptability. We will talk a little bit about the wage index process that's going on. We'll talk about the desk review and audit feedback, the S10 audit process. We'll spend some time there. Talk about the Federal Register final rule, just a few highlights from that. We'll spend a couple of slides on the RHC productivity standards. And then one thing I did want to spend a fair amount of time on is the new change request 11642. Dealing with the GME Nursing and Allied Health Managed Care changes. And we'll spend a couple slides on the EHR, now known as promoting interoperability, the payment reductions, just some information I wanted to put out there. And then again, there's going to be some time for questions at the end. So any questions you might have that we didn't address throughout the session, feel free to ask them at that point. So first of all, the new cost report acceptability requirements. Now, when I say new, they've actually been around for a while. They were published in the August 17th, 2018 Federal Register, and they were initially effective for cost report periods beginning 10/1/18 and after. So they've technically been effective. They were in the Federal Register, but there really hasn't been any further instruction from CMS on that until they recently issued change request 11644, and I have a link to the CMS website where you can find that. That's also the one that keeps popping up every time when I get off the slideshow. But we have that out there. It's now effective for cost reports received on or after 12/31 of 2020. So what that means is we as MACs now have it in our acceptability checklists where we have to look for these items. We're going to see some illustrations here in just a bit, but I wanted to give you that link. You can find that in the PowerPoint attachment in your email if you'd like, or you can just search for it on the website as well. But basically, these changes, if they're not met, they would cause the cost report to be rejected. So, of course, nobody likes that. Just something we need to be aware of there. The changes related to the supporting documentation, basically what must be submitted. So bad debts for a long time have had a requirement that a listing is submitted, but there was never a more in-depth requirement that the amount tie out to what was reported. And the same thing goes with GME. We're going to see all of those. Now that's really the change. Not only must the documentation be submitted, it must actually match the amount that was reported. So that certainly makes sense, but now they're just adding to the requirement there. This is an excerpt of the checklist. So this is, one situation where CMS has released an acceptability checklist to the public. Some of these things come to the max only, but this change request, they release this for public viewing. And this is a step on that checklist. So as it says, in order to accept the cost report, questions 1 through 5, 8, and possibly 6 and 7 must have a yes response. 6 is the big one in question here. And again, you can see that it was for cost report periods beginning on or after 10/1/18, but it deals with these different issues. It deals with bad debt, detailing the bad debt listing. There has to be a detailed bad debt listing that corresponds to. Now, I want to come back to that phrase in just a bit. Corresponds to the amount of bad debt claimed in the provider's cost report. The DISH, basically the same thing here. It has to show the Medicaid eligible days, the DISH days basically, that correspond to the amounts claimed in the provider's report. Charity care and uninsured discounts. So this is basically our S10 reviews. But again, whatever you report on S10 has to correspond to the amount claimed on the cost report. I do want to point one thing out here, which we're going to get to in the S10 reviews later on as well, that we are not just reviewing charity care and uninsured discounts. Certainly that's an important part, probably the biggest part of S10, but we also have total bad debts on S10 line 26 that we review. Now, it's kind of unfortunate that CMS did not include total bad debts in this because we do need that to do the review. So we certainly prefer you submit that as well up front with the cost report. However, that's not an item we can currently reject for. So if the total bad debt listing is not there, we'll probably be sending you a request for it, but that one piece will not be rejectable. And then the other one that was sometimes even bigger, the home office cost allocations. Basically, for any costs allocated from a home office or a chain organization, CMS does go into great detail in that Federal Register that we just referred to a bit ago. But if there are any costs there, there must be a home office cost statement submitted to the chain provider's service and contractor. So what that means is it doesn't have to go to every single MAC that you deal with. If you have a chain that has providers across all or multiple MACs, it only has to go to the MAC that services that home office, and then it will be disseminated out to the other MACs that way. So that might save you a little bit of time there, but just be aware of that requirement. So now let's just talk a little bit about the specific requirements. Some of this we already talked about. With the teaching hospitals, IRIS data has already been required for years, decades really. The big difference here is that it now must be submitted in order for us to accept the cost report. And the FTEs, they need to match what you're reporting. Bad debts, I already said that. The detailed bad debt listing must correspond to the amount of bad debt claimed on the cost report. DISH, we went through that one. Charity care, so all the other ones we went through already in that listing. But I do want to point out that phrase correspond to. It's somewhat of a vague term. It is a vague term. Basically, we thought initially that it meant, hey, it had to tie out pretty much exactly, maybe within a slight rounding difference, $1 or $2. And that was quite a bit of discussion between the MACs and CMS on exactly what corresponds to means. CMS has clarified that in the change request. And again, this is all public. It's on the CMS website. So they have now stated that corresponds to essentially means there could be a plus or minus 3% variance. So gives you a little bit of leeway. Of course, it should be basically exact, again, within dollar rounding, but they're allowing up to a 3% variance. If it's less than 3%, then we can still allow it. But of course, when we come to the desk review time, we'll be asking why is there a variance, which amount is correct, basically. So that's the concern there. Now, I do want to mention we have on our website, it's been out there for a while now, actually over a year. It was right after the Federal Register came out. There's a separate web page, and there's also a linked YouTube video discussing, this should actually be the cost report requirements, not S10, but they're discussed in more detail. So if you go out there, I mean, it includes the S10, it includes the charity care, all of that, but it also includes the bad debt, dish, all the other items there as well. In fact, I have a screenshot that we'll see in this next slide here that shows you where that is, where it can be found. But again, it's a YouTube video if you want to go through it. It's close to an hour, 50 minutes to an hour, so it takes a while, but it goes through really everything. It goes through the templates and just explains why we need the information, what we really need, all of that. So I think now I will just move to that screenshot here. So it's out on our website. If you go to the audit topics, and if you go into the cost report section, you know, we have the listing of key issues, and each of them have their own articles underneath of them. You'll find the cost report documentation requirements and templates. And if you go out there, it really goes through a lot of the same things we just talked about. Talks about the Federal Register, it links to it, when it was effective, what items that Federal Register included. And what we will probably be adding now to this website is that 3% variance, because right now it said correspond to, and we assume that meant tie exactly to. But in any case, if it's greater than that 3% variance, of course, we're going to be rejecting for it. So here's the link to the YouTube video that we have on this. Now, if there are any questions, by the way, on these topics, we have an email address out there, newacceptrequirements@wpsic.com. You can send any questions you have about that there, and we can address those. That would be the audit supervisors looking at that. I look at it from time to time as well. And then from there on, we go throughout all of various topics, bad debts, dish eligible days, all of that. And then we have the template for that particular topic linked down here. It's an Excel template. The bad debt one has some formulas included in it, and it just makes it easy to use. Yes, there's quite a bit of information, quite a bit more than what you would have seen in the original Exhibit 2 for the bad debts that you might be submitting for current cost reports, or at least the ones in the past few years. So this does include more information, but really it's information that we need at the time of desk review or audit. So submitting it now saves a step down the road. You won't have to try to find that information again and send it. A lot of times if you're in your systems already gathering the data, it might be just as easy to pull those extra fields also. And some of it really, we hope, serves as kind of training or clarification on certain items. So feel free to take a look at that. The YouTube video goes through that in much more detail. The other ones don't have quite as much automation. We spent a little bit more time with the bad debt ones. The Medicaid eligible days, of course, there are a variety of types of dish Medicaid eligible days. Certainly depends on the state you're in. So there's the template out there. Now, as far as the home office, there's no real template for the home office other than, of course, the cost report form set, the CMS approved cost report form set. We don't have any sort of separate template like that. So whichever vendor you might be using for that, send it in the normal way. If you need to be approved for a home office number, you can certainly send that in. And we do have a questionnaire out that it's a new home office questionnaire that you fill out if you'd like to be set up as a home office. So if you have any questions on that, you can certainly send those in. You could send them into the new accept requirements if you want. We could send that checklist back out to you and get you in contact with the supervisor that deals with that. It's Christy Rorick. So one thing I want to mention there is that these templates we've included, the majority of them were developed in conjunction with the other MACs as well as CMS. We've had work groups started a few years ago. They continued on for a while, and then they were wrapped up. But they're not required at this point. These specific templates are not actually required. So I just wanted to point that out. They're optional. We do need some sort of listing, but it doesn't absolutely have to be in our template. We recommend it. Again, it's not required. So if you use something else from your own system, please just make sure to name it accordingly so we can tell right off the bat when we're accepting these. Do you have a bad debt list? Do you have a dish list? S10 support? Now that goes whether you submit it through the MECREF portal on the CMS website or whether you send it to us via CD or anything like that. Just make sure that listing is clearly identified. We only have 30 days internally to accept these for the most part. So obviously now there's a lot more work to do at acceptability than there was in the past. Of course, that goes the same for you as well as providers, that there's a lot more work on your part as well. So this should just help with the acceptability process. It'll prevent follow-up requests. It'll really save everybody a little bit of time if it's named properly. So now I think we can move in to the wage index discussion. Now, any acute care hospital out there right now, you're probably well aware of this. You're already involved in this process right now. MACs currently have until the middle of November, 11/16, to complete all the desk reviews for the wage index. So you've already been likely working with the wage index reviewer for your hospital. They've been requesting certain things. So we have till 11/16 to transmit that data, the revised or the adjusted S3 wage index data, to CMS. They take a look at it. They analyze it. They may follow up with us right away with some questions if anything looks unusual. That kind of goes to this next slide. Even though the wage index desk review process itself is complete, at least initially complete in mid-November, there are a lot of edits that CMS performs, and if anything looks unusual, they'll come back to us and they'll ask us for additional data, possibly additional review. So, of course, that means we're going to have to, in most cases, get back with the hospital for that additional data. And there are some tight time frames for that, because keep in mind, all of this is leading up to the next year's proposed rule and then the final rule. The proposed rule is usually right around late April, early May, and then the final rule is usually in August. This year it got delayed quite a bit, of course, due to COVID. So that's what all this is leading up to. That's why there are tight time frames. As you can imagine, this is a lot of data for CMS to review in a relatively short period of time. On January 29th of next year, that's the due date for CMS to release, that's their time frame at least, to release the fiscal year 2022 wage index and the occupational mix files under the public use file. So that'll be available on the CMS website. They usually communicate that pretty well, so you'll be aware of it, and you'll be able to identify if there are any concerns. And that leads us to this next time frame of February 16th, 2021. That's your deadline for providers, for hospitals, to submit their requests for any sort of correction. Maybe they believe it was mishandled either by the MAC or CMS or just anything like that. So that is a due date, and MACs must receive the requests as well as the supporting documentation. We need to see, why do you think there's an error? So we need to see that data. We need to receive it by February 16th, because then we have to turn around and potentially do some more review on it, depending on how broad it is, what exactly it is. And we have until March 19th to submit that final revised data back to CMS. And then, of course, we'll notify you as a provider, basically just a response that, yes, we've received it and handled it in one way or the other. And that takes you to the next deadline here, April 2nd. that would be the deadline for any hospital to appeal MAC determination. So it is a very tight deadline for appeals, much tighter than most cost report appeals. But as you can imagine, it's such a tight time frame to begin with. As I said, CMS needs this data to be able to issue a proposed rule. And then, of course, changes might be made by the time they issue the final rule. So that's where we currently are for the wage index. Again, it really only impacts the acute care hospitals, but as far as the review, it has a broader impact. The results have a broader impact, but that's the time frame we have here. The next topic I wanted to discuss here was with provider feedback, the idea of provider feedback. We at WPS, certainly in the audit department and others, we're always looking for any sort of feedback on what we can do to improve, what we're doing right, what we need to improve upon. So we first started this a few years ago with mostly our field office audit staff that handle the in-depth audits and the more complex desk reviews. So any of you providers, whether you're an acute or a critical access hospital or whatever type of provider, if you've dealt with the field office, if you've dealt with an in-depth audit, you have probably already received one of these feedback forms, and it's sent out by the audit manager. Once that audit or complex desk review is completed, it's just sent out asking for feedback. It's a little brief questionnaire, and it's, of course, it's optional. It's not going to have any impact on your settlement or anything like that, but we certainly appreciate when you send that in. When we get it, it goes to the audit manager, and they aggregate the data. They take a look at it. They analyze it. Sometimes they may have follow-up questions if there's a contact included, but ultimately they share the results with the auditor and supervisor that performed the secondary review, whoever the reviewer was. And then we have meetings from time to time, all levels of management, just to talk about certain things, to see what do we need to do, what are we doing right, what may we need to improve upon. And again, it's a coaching tool. So that's the idea behind it. It's a brief questionnaire. It has a score of 1 to 10. 1 is the lowest, considered poor. 10 would be excellent. Just 5 questions. If you have comments to add to, that's perfect. That helps rather than just a number. So we can see, especially if it's in the middle or low, we kind of want to know what can we improve upon. If we just happen to see a 5 or 6 out there with no comment, then we don't really know what needs to be improved. So any little comment, whether it's a brief comment, if you have something else to submit with that, certainly that's fine. Again, we appreciate it. So that's been that way for the past couple of years with the complex desk reviews and the audits from the field office staff. But we didn't really have the same mechanism for other areas of audit, including our less complex desk reviews that are handled out of our Omaha office for the most part, and reopenings, appeals, things like that. So we expanded it a little bit by setting up a tool on our website. It's on the cost report audit page of our website. And basically we have a new email address that is for this same purpose. It's not the same structure. It's not a rating system. It's just a regular group email address, but it's auditfeedback@wpsic.com. So when you send that in, our management staff take a look at that, and we go through the same basic process. What are we doing right? What can we improve upon? But certainly if you send one in, please, to help categorize them, please specify in that subject, what category does this relate to? For example, is it an acceptability issue, a tentative settlement issue, desk review, audit, reopening, appeals, anything like that? There's not a drop-down list or anything like that, so it's not quite that specific. But if you could put something in the subject that leads us to quickly see what the issue is about, and if possible, if you could include a provider number or provider name so that we can research the issue on our side and see what might have happened. But really, again, any feedback you have is great. That's what we're looking for to try to improve our operations. Now we'll move on to a bigger topic of S10 audits. Right now, this is impacting really every well, every acute care hospital that is eligible for DISH. So it's not quite every acute care hospital, but certainly it's the vast majority of them. So we're going to go through just a brief history of this, everything that led us up to today. So with the initial year, this was 2 years ago, we obviously the first time we've seen S10 as far as an audit perspective. The S10 form, the worksheet on the cost report, has been there for a number of years. It's been there for over 10 years. I think it was 2003 or 2004 when it was first put in, but it wasn't really used for anything up until very recently. So the initial instruction that Max got about this first year of S10 audits was way back in July 30th of 2018. And to start off, CMS said they realized we weren't going to be able to review every single audit, every single provider at that time. So they took a look at all of the 2015 DISH eligible providers, and they identified the top 50 cost reports per MAC. So we as WPS, we have 2 MACs. We had 100 total units. And by the way, I just want to stress, when we say federal fiscal year 2015, it's the cost report period, any cost report period beginning within that federal fiscal year, so 10/1/14 through 9/30/15. So that same thing will apply for future years as well. But they gave us an audit program, a pretty in-depth one, and they wanted us to review the data that was submitted by the MACs, by the providers, to take a look and see if that number was proper. What was reported on S10 line 30, ultimately, what rolls up to line 30. We had a HCRAS due date of January 31st, 19. So as you can imagine, we started the very beginning, July 30th of 2018, a brand new process, and everything had to be done by January 31st of 19. So it was a very compressed time frame for something we were really all just learning, brand new. And finally, in August of 19, the federal fiscal year 2020 final rule was issued, including some of the results from that data. And it was effective for 10/1/19 rates. That's federal fiscal year 20. So that first year was effective. Again, the rates were impacting the uncompensated care payment. Year 2, last year, we received instructions a little bit earlier, May 13th of 2019. This time they jumped to fiscal year 2017 providers, which, as many of you probably know, that was when the cost reporting instructions changed for S10. So we took a look at those fiscal year 17 providers, and this time they went with the top 650 from a national perspective instead of looking at just 50 per MAC. Now, we, as WPS, we ended up having, I think, 98, if I remember right, 98 units, it was 91 actually, 91 cost reports to audit instead of the 100 the first time. It's just the way it rolled out. Some MACs had more than others, just depending on how everything ranked. Now, this is just J8 information, but we had the others were J5. So we had a little bit more time with year 2. They were still due to be completed by 12/31 of 19. And the data from those years ended up not being used right away. CMS decided, well, let's continue to use the 2015 data one more year. So they used it for 2 separate years' rates. But ultimately, in September of 2020, they finally decided to use 2017. So this one just came out just last month. Again, it was a little bit later than usual, but it came out last month. The data from the 2017 cost reports is effective for rates starting 10/1/20, so a couple weeks ago. So that's already being used. Keep in mind the second year of the 2017 cost reports, it was still just a partial audit. And by that, I mean not every single provider was audited yet. Now we're in year 3, what we're working on right now. And we currently have 498 providers. Actually, I think that should be 494 providers that were selected for audit. It's really basically any DISH eligible provider. So it wasn't even a selection. It was any DISH eligible provider. Now, that includes providers like Soul Community Hospitals that may or may not receive any incremental benefit from the uncompensated care payment. They're still included in that review. CMS has stressed this multiple times. In fact, it was included as comment and response in the Federal Register that just came out in September. So we are still having to audit those SCH hospitals. And we were taking this data. We assume it's going to be used in the next rule, but of course, until the proposed rule comes out, who knows? CMS may decide to use a different year or change it altogether. But that's our working assumption, is that the audits we're performing right now will be published in the May 2021 proposed rule. And we assume they're going to be effective for 10/1/21 rates and on for that year. So again, we have, again, I think the number was 494 actually. Now it started off great. We got some of the draft information early. We were able to send out requests at the very end of February. We thought, hey, we're getting a head start on all of this. And of course, the whole world changed a little bit in March with COVID-19 that's still going on. So a lot of that stuff was paused. We did get some providers sending in early, and that was great. But the request due dates were paused until May 15th, and then they picked back up. We've had some extensions just on a case-by-case basis since then for providers that are having issues getting the data in at that time. But they're underway. Our deadline is still locked in at 12/31/20. So if we have a few providers that still haven't submitted data yet, and we're trying to work with them. Unfortunately, if we don't get any data, if we don't get any documentation, we will have to adjust that to 0, and it could have a pretty substantial impact on your DSH uncompensated care payment. Keep in mind, I know this is not a topic we've covered here, but the uncompensated care payment is basically taking the place of 75% of your old DSH payments. So getting that adjusted to 0 is certainly not a good thing for any provider. Just keep that in mind. Now, we hope next year will be even more streamlined. We understand this is the first year for basically 80% of the providers we have, because we jumped from 91 and 100 providers in the first 2 years to now nearly 500 providers. So a 5-fold increase, and a lot of you haven't been audited at all until this year. In addition, we have a lot of new audit staff we had to onboard to be able to handle this increased workload. So it's a learning curve on both sides. We hope next year might be even more streamlined. We hope some of these templates will be out there from CMS, and we hope now that everybody's had a chance to go through it one time, hopefully the learning curve it'll be better next year. Some highlights here. So we have $8.3 billion to be distributed through this uncompensated care pool, which was up from the proposed amount of $7.8 billion. Now, some of that change is due to the fact that, there was an estimate all along when this uncompensated care was first started. The estimate was that the number of uninsured patients that this was supposed to help to fund, there was an assumption that that number would continue to drop, in part due to the Affordable Care Act and some of the other changes. But of course, when you have things like COVID-19 going on, that assumption may not hold as true as CMS initially thought. That's one of the reasons that led to that increase here. For fiscal year 21, they are using they did use, I should say, it's already effective. They used the 1 year of cost reporting data from 2017 for their Factor 3 calculation. Factor 3 is just the hospital-specific percentage of that uncompensated care pool that's being used. June 2020 HCRIS was used for final rule. Now, that was this year only. They made an exception. They used a little bit later data than they usually would, again, partly due to COVID. But they did, in this recent Federal Register, they stated that for future years, December HCRIS, whatever data is available at the end of December, which will include this year's audits, is going to be utilized for the proposed rule, and March HCRIS, a few months later, will be used for the final rule. So they're not going to go all the way to June. They're going to cut it off at March. obviously to get the data ready to go for the final rule. In that proposed comment period, the proposed rule, we submitted comments regarding the potential to start even earlier next year, at least for providers that are ready, at least if we can get started at some level early. If everything's still going to be due by 12/31, then the idea was that it might benefit everybody. We have a lot more flexibility and leeway. CMS responded that they're not going to mandate any sort of early time frame, but they'll work individually with MACs. So we're hoping that we can at least get started maybe in February or very early March of next year, at least sending out the request letters so providers are aware of this. But until we hear more from CMS, we don't really know for sure about that time. And we do expect this 100% audit to be completed year after year. In other words, all of the DISH eligible providers rather than just a small subset of them. So we expect that to continue on. The other thing I'll mention here, which actually touches on something we'll see later, is that presumptive eligibility. In other words, this is eligibility that's not necessarily determined by the provider, but they're relying on some other third-party tool, sometimes income-based, sometimes credit score-based, just consulting firms. Presumptive eligibility is allowed for charity care, even though it's not allowed for indigent bad debts on Medicare, on E-Part A or E-Part B there, but it is allowable for charity care on S10 as long as it's clearly stated in your policy, in your charity care or financial assistance policy. We're going to see that concept come up multiple times. Basically, it has to be in your charity care policy or financial assistance policy before it's allowable at all. And I'm going to stress that in just a bit here. But I do have a question I wanted to go to. Somebody was asking, why do hospitals that don't get paid on DISH, for example, the sole community hospitals, still have to go through these detailed audits? And that one's been asked a few times. It was actually in the Federal Register as well. CMS's response was, for one situation, there's no guarantee that in 2 years, by the time these rates are effective, that hospital will still be a sole community hospital. They may lose eligibility. It's possible the rate structure may change so that, before you weren't getting any incremental benefit, but now maybe you are in a later year. So that was their response. Now, certainly there are some sole community hospitals out there that have such a discrepancy between, or such a variance, maybe I should say, between the actual federal rate and their hospital specific rate, that there's virtually no way that would ever change. You'd virtually never get a benefit. But CMS was sticking to that point that there's no guarantee that a hospital would remain a sole community in 2 years. I mean, for example, if a new hospital opens up down the street, then you lose your status right there. So that was really their response. I know it is unfortunate when it turns out that you never do have a benefit from it, but you still had to go through the audit. Who knows, CMS might change that in future years, but they did hold firm in this recent final rule that they were going to continue to require S10 to be performed for sole community hospitals. So very good question, though. So going back to that charity care policy issue, I said earlier that it has to be in your charity care or financial assistance policy to be allowable. CMS has stressed that with us multiple times. It's part of our audit program that we look at. And to try to educate providers on this, try to make sure they're aware of the importance of this, even going forward, we sent out a letter on September 18th, and this went to all acute care hospitals regardless of their DISH status. It's informational only. It was clear in that letter that it's informational only. But the idea here is that we wanted to just let you know that if you're including something on S10, line 20, that'd be where your charity care is reported, then we want to make sure you're aware that whatever you're including has to be included as part of your charity care policy. So charity care is kind of an unusual thing, I guess, under CMS for things like bad debts, indigent bad debts, for example, on E-Part A, the Medicare bad debts. they have very stringent policies that we're actually going to be touching on a little bit later, but they have very stringent policies on the fact that the provider must make that determination, and they must have reviewed assets, liabilities, revenues, and expenses. So they're very stringent on that. But for charity care, CMS has said, hey, it's up to the providers to determine what they are going to allow for charity care, but it has to be in their policy. It can't just be in their practice. It has to actually be in their written policy. And I will mention one thing that was just very recently stressed. It has to be specifically in a charity care or a financial assistance policy. It can't be included in something completely separate. It has to be somehow referenced in your charity care or financial assistance policy. Now, if you do have some other differently named policy that includes something like maybe non-covered charges, Medicaid stays that exceed the length of stay limit, if they're in another policy, at least put a link to that policy in one of these two policies. Otherwise, basically, there's a risk that we might have to disallow that going forward at least. Again, we're taking this year, we're trying to educate providers on this so that you have a chance to update your policies to follow your practice, essentially. So what we're doing with that letter, the whole idea was we're recommending that all hospitals review their charity care policies to see if they align with their practices, and if not, just to update that policy and really try to be as clear as possible in there rather than just vague language. Try to be clear. For example, which I got on the next slide here, do you allow uninsured or self-pay discounts? If so, clearly state that in your policy. And how about charges for patients with coverage from an entity that does not have a contractual relationship with your facility? So if the patient is technically insured, but the insurance, you don't accept that insurance, you don't have a contractual relationship, if you allow those charges to be considered charity care, just clearly state it. Co-insurance deductible or co-payment amounts related to insured patients, some providers allow that as well. Just, again, clearly state it. We have a few Medicaid items here. If it's a non-covered service related to Medicaid, if you allow that, make sure it's stated. Any charges for patients that have exceeded the length of stay for Medicaid, that's a separate item altogether, by the way. It's reported separately on the cost report, line 25, and line 24 is a little indicator that you have that. So that needs to be stated. Any other insured patients that have exhausted their benefits. And the other thing that should be in there is related to bad debt, Medicare bad debt, just more of a control than anything. If you have deductibles and coinsurance amounts that are claimed as Medicare bad debts, then they can't be duplicated as charity care as well. You can't get the best of both of them. You can either report it as a Medicare bad debt, or if you did not claim it as a Medicare bad debt and it wasn't a bad debt at all, then you can report it as charity care as long as it's in your policy. But just make sure that you have a control in place that ensures that they don't get reported both places. Now, I do want to mention something here. So kind of tying to that second to the last bullet point, we have seen some situations where Medicare patients, so again, it would just be the deductibles and coinsurance amount, but we have some Medicare patients that have showed up in the charity care listing. Now, that is a pretty high risk item because it seems like that must be a duplicate, but we've had responses from providers that no, we did not include that as a Medicare bad debt, perhaps because they didn't meet the Medicare bad debt criteria. They didn't write it off as a bad debt at all. And in those limited situations, that could potentially be allowable as charity care. But it is such a high-risk item that we're going to be asking questions on that. We'll look for documentation on, why didn't you write that off as a Medicare bad debt? So just be aware of that. Not saying it's not allowable, but it has a higher bar for evidence than most of the other charity care. And yeah, we have another good question here. Let me see, make sure I didn't miss any. So does everything claimed as charity have to be adjusted with a charity transaction code in the patient accounting system and routed to a charity general ledger account? So that's a good point. If it's going to be charity, then yes, it would have to be written off in your accounting system as such. Because keep in mind, the write-off date that we're going to be looking for detailed documentation for, the write-off date is what determines what cost reporting period it goes into. So if we happen to sample that item and we're asking for documentation, we'll look for the write-off, we'll look for how was it written off. But keep in mind, you might also have things like uninsured or self-pay discounts that might not normally be considered your normal type of charity care. It's just a self-pay discount. It's almost a presumed charity care, if you will. So in that situation, you might be writing it off in a different way in your accounting system. And really the policy should help explain that. Or if we have follow-up questions for things like uninsured self-pay discounts, just make sure you can explain that it was in your policy. That would most likely be in something like the financial assistance policy as opposed to charity care. It's allowable either. But for the most part, your answer would be yes to that question. They should be written off with some sort of charity transaction code. And one of the things we're going to be asking for as part of our audit is a listing of those types of codes. So we have that. And really, it all boils down to being able to explain what those codes were, why it was written off a certain way. But ultimately, if it's in your policy, that's ultimately what's important, and it had to be written off in that period. So we have those items that you might want to make changes to your charity care policy if it's not specific enough. And then the other thing related to these audits, we have the S10 templates. And this was attachment D to the, we call it the attachment D template, or just the revised S10 templates. But this includes some S10 cost reporting instructions. It includes instructions for the template itself. And it includes 3 different tabs: a charity care listing, the patient payments listing, and the total hospital bad debt listing. So this was given to us from CMS, and basically it was also the product of a work group with multiple MACs. So it wasn't just CMS forcing this, it had input as well. We did take that template and we revised it a few different ways. We revised some of the column headings to make it even clearer what they were looking for. We revised the order of just a couple columns. I think it was the write-off date. We moved it so it wasn't in the middle of a few different amounts. And we definitely included several additional notes in the instructions tab to help clarify what we're looking for. But perhaps the biggest change we made was to add what we called the query logic questionnaire for providers to use for really 2 purposes. We hope it serves as a little bit of training and education on exactly what we're going to be looking at and what types of explanations we need on how you've submitted some documentation, how you've queried your systems to grab that documentation. Because just to stress that point, anybody that's gone through an audit would have already probably heard that term query logic from the auditor. And I think that was in the initial listing we sent out, the initial letter we sent out as well. Basically, it said include a description or a narrative of the query logic you used to grab the data. The idea here is that we want to get some sort of assurance on how did you make sure that you're only including things that were allowable, only including charity care, for example, or on the bad debt listing that you were only including actual items written off as bad debt, and specifically not professional fees or any sort of physician fees. Those are excluded altogether. So we wanted to make sure how you were ensuring that happened. How did you ensure that you only grabbed write-offs within this period? How did you ensure there were no duplicates? How did you ensure that you accounted for all the patient payments that might have come after a charity care write-off? So that's really the entire purpose of the query logic. But instead of just putting a vague statement like, hey, send us query logic, we decided to get into more detail and create this questionnaire to pinpoint certain things we're really looking for. We shared these changes with CMS and we sent them to other MACs as well. So if you're a hospital chain that deals with multiple MACs, it's possible you might have already seen that same questionnaire come from other MACs as well. And we're perfectly fine with that being shared. The whole goal is to help both the provider community as well as the audits being performed by the MACs. Because if providers better understand what we're looking for, it saves a lot of back and forth. That's the idea. And it might even save you time trying to figure out how do you pull this data from your systems. If you know really what we're looking for, then it's just going to save you time there. That's the hope. So to find this revised template, if you go out to the WPSGHA.com website, you'll see we now have a new section for Worksheet S10 Uncompensated Care. This previously was reported under the DISH topic, but now we've separated it out. We have two different articles there, and one of them is just the S10 Charity Care audits, and that's actually where you'll find all this detail about the templates, the YouTube video that we've created, all of that. And we also have this new one that just details what we just talked about for the charity care. So you'll find that out there as well. Feel free to check that out. Again, you should, I guess these are just screenshots, so you won't have the link. But if you go to the WPSGHA.com website, click on the cost report audit topic, you'll be taken to all these audit subtopics, and just search for this one and you'll find these two articles. These are hyperlinks, by the way. The template you can download, the YouTube video, it'll take you straight there. Even the email address if you have any questions on S10. Now, your first choice for questions would be the auditor you're dealing with. But if it's outside of a normal audit period and you have questions, feel free to send them to this address. We'll take a look at them. This just breaks down that query logic questionnaire tab, 23 questions. Again, it is optional. It's not a required thing at this point. We hope it helps you. And if you don't answer the questions this way, they're probably going to be sent by the auditor throughout their audit anyways in some form or fashion. So this just puts them all in one quick and easy document to respond to. Just a couple of excerpts. I gave some of these examples a bit ago. How did you generate your listing to ensure that it only includes charity accounts that were actually written off to charity care in this cost reporting period, regardless of when the underlying service dates were? What transaction codes or other codes are used in your operations to identify charity care versus other contractual adjustments? And then for the patient payments, how did you ensure that the patient payments reported on S10 line 22 are only those that related to a charity care amount that was written off in a prior cost reporting period? So I know this is not a full-blown S10 training, but I do want to stress that point of payments out really quick. We discussed it in depth in the YouTube video and the website. That patient payment on line 22, it's not expected to be a very high number in most cases, because what it relates to is not all patient payments, but only patients that have already been written off for charity care and the patient still decided to make a payment against that charity care approved amount after the fact, and it was accepted by the hospital. I know some hospitals have policies that they return those amounts to the patient. They won't even accept it. But if the provider does accept that payment against a previously written off charity care, that's what line 22 is for. So I just wanted to stress that point. It's definitely not all patient payments. It's just the relatively few times the patient will still make a payment against a charity care approved amount. Let's see here. We have bad debts. It's really the same thing. It was the write-off date. How did you ensure that your listing only included write-off dates in that cost reporting period? The second one, are there Medicare bad debts reported on line 26 that are claimed in a different cost reporting period for Medicare bad debt reimbursement? For example, worksheet E Part A or E Part B. We did just recently get clarification from CMS that they do agree line 26 should reflect when any bad debt, Medicare or otherwise, was written off for financial accounting purposes. even if that same bad debt might not yet be allowable for Medicare. For example, the biggest example is if you have a charity, or I'm sorry, a collection agency where you've sent that to an external collection agency, you've already written it off internally. It's already a bad debt on every financial statement you'd have, but you can't write it off for Medicare because it's not been returned from the collection agency yet, and maybe won't be until the next year. That is still allowable on line 26 of S10, and then maybe next year it'll be allowable on E Part A, for example, for Medicare. By the way it works, for those of you that haven't really seen S10 in detail, the Medicare bad debt amounts, the 35% that's not reimbursed comes over to S10 and it impacts the total amount that's allowed on line 30. So even if you're including a Medicare bad debt in total on line 26, which you should be, you're not getting the benefit of that total amount. It's only the 35% that hasn't been reimbursed. So I just wanted to clarify that. Moving on to the next one, we have the fiscal year 19. This is, the fiscal year 19 IPPS. No, this was, 2019. I'm sorry, I'm jumping to the next topic. It was the 2019 IPPS final rule. Basically, that's what changed the required supporting documentation that must be submitted with the cost report. It's the one we just talked about, the one that we talked about with the acceptability, how you have to have the S10 documentation for the charity care, all of that. Now, I do want to mention, though, just a reminder that all those formats we talked about, they're just optional at this point. However, CMS has stated, and they even mentioned in the Federal Register just recently, last month, that they are sending these through what they call a Paperwork Reduction Act notice. It's going to go through the Federal Register again because they're trying to get some of those formats standardized, which we hope will help both the provider and audit communities. But they're not required. They're preferred, they're recommended, but they're not required until further notice. And you'll have a chance to comment on that whenever that particular rule comes out. Now, I touched on this a little bit, but our WPS website, here we have all the different links. This one takes us to the S10 sections, the two different S10 websites. It includes links to two separate S10 YouTube videos, and as well as the questionnaire, all the provider training, all of that. So these are just some links you can use later on if you'd like. Now I wanted to spend a little bit of time on the Federal Register final rule from this year. This is what I was trying to jump to a bit ago. This one was just published September 18th of 2020. Here we have the hyperlink below it. The second hyperlink takes you to the CMS website where all the tables can be found. Now, like any annual IPPS Federal Register, the final rule, there's a lot of data related to just your standard rate updates and wage index information. And certainly we're not going to go through that in detail here. It's important for anybody that's being reimbursed on PPS, so all acute certainly, and the other hospital types want to see that. But we're going to really give more highlights from this Federal Register, some of the things that aren't your standard types of changes. So one little small item that popped up was with Soul Community Hospitals. And here, this only impacts those hospitals that are being eligible for Soul Community Hospital based on their patient utilization, how that compares to another hospital. So CMS clarified in this case, if you have a short period, that's the one you're normally using for your qualification, then we should be using the most recently submitted, or I should say just the prior 12-month cost reporting period right before that short period, and that's the one we'll use for that data. The low volume payment adjustment, that one has already been wrapped up for the year. It was extended, surprisingly, to 9/15. Normally the due date is 9/1, but the Federal Register hadn't even come out by 9/1. Usually it's around mid-August. So they did end up extending it to 9/15. but by the time they extended it, we had already received most of our low volume providers. We sent the letter out. We recommended that you submit it prior to 9/1 just in case. And they ended up giving everybody a little bit extra time. That did benefit a few providers that needed that extra couple weeks. The approval letters have already been sent out they were sent out on 10/1 in the mail. And also anybody that had emailed their request in, we followed up with an email response as well. And I will recommend that, by the way, anybody that qualifies for low volume in later years, submitting it via email makes it a lot easier, hopefully on your part, but definitely on our part. And then we can respond quickly to that. We can respond with the approval letter as well. So we prefer that. Of course, we'll accept hard copy, whatever works best for you. And the Federal Register, the way it stated the requirement, it was for the most recent cost reporting period submitted as of the date of your request. So whichever one you had submitted, it didn't have to be accepted at that time. Whichever one was submitted, that's the one we're going to use the discharge data from to determine, first of all, your qualification, and second of all, your actual percentage. So that's been approved. Those are all out. Everybody that was approved should have already received it. The rates from 10/1 and on are already being paid with that. So hopefully there are no questions there, but if there are, feel free to send those on to the audit advisement email address. We're the ones that handle that. Of course, S10 rule changes, those were big in that final rule. We already talked about those, though. Another new change, the stem cell organ acquisition. This is one new, if you want to call it an organ, it's they're including these in organ acquisition cost reimbursement. It's effective for cost report periods beginning on or after 10/1/20. The last ones we had added were the pancreatic islet cells, and now we have a new set here. So I'm not sure how many providers this impacts yet, but CMS has their own qualification requirements, certification requirements. Let's see, another one I wanted to talk about deals with the appeals side. And this was CMS's attempt to prepare for upcoming mandatory PRRB electronic filing. So they've had the electronic database in place for a few years now. It's been recommended but not required since the beginning. We are seeing more and more providers starting to use it when they have an appeal, a cost report appeal. We think it streamlines it for the PRRB, the board themselves. It certainly streamlines it for auditors, for the MAC, the appeal specialists, especially in the current environment we're in with COVID-19, a lot of people working remotely. For a while there, the board wasn't able to even go back to the office to access hard copy documentation. I believe they're back there now. They're going through some of that. So the electronic filing just makes sense whenever possible. But CMS, they decided not to mandate it yet, but they're setting the stage for mandated use of that. They did say they want to wait until at least 2021, and I believe they're just talking about really calendar year 2021 at that point. So they're going to wait until then to require electronic filing, and they're going to issue a future rule, a proposed rule, first of all, for comment, and then, of course, a final rule. So more information to come with that. And the next few slides we have are dealing with some of the bad debt issues. This was, from an audit perspective, one of the biggest things out of this final rule. And they basically have codified a lot of the policies they had for bad debts that were in the CMS policy manuals. They've codified them now into final regulation. A couple of them have changed slightly, and there's one pretty big change at the end that we'll talk about. But I just wanted to go through here and separate these or categorize these because some of them have retroactive effective dates. If CMS believes it's really the same policy they've had all along, they're just codifying it now. But other ones had slight revisions, and therefore the revision is going to be prospectively effective 10/1 and forward, whereas the old, just the policy itself, would be effective back for the older years. So the 4 items that were included that they matched current policy were the collection effort for non-indigent patients. In other words, your normal collection effort. It can't be a token collection effort. It has to be progressively more, it just has to be progressive collection effort, I guess. Progressively more aggressive, maybe that's the word you want to use there. But you have to show that. You have to document it with a letter, phone calls, things like that. All the normal collection effort rules. Similar collection effort between Medicare and non-Medicare for certain classes of bad debts. In other words, dollar amount classes. If they went through one stage of collection effort for Medicare, then they should go through the same collection effort for non-Medicare or vice versa. The next one is what's normally known as the 120-day rule, even though rule is kind of a misnomer because it's more of a guideline. But what they're saying here is that any token payment, even if it's $1, $2, if the patient makes a payment, that resets this 120-day rule. In other words, you have to continue collection effort for 120 more days from that, even if it's a token payment, before it can be written off. Now, when I say the rule is a misnomer, what we're basically saying there is there are some situations where a provider can show that they have very good reason to believe that continued collection effort will be futile. And in those situations, if you can document that, then you can actually write something off prior to 120 days. But again, that is a higher level of evidence requirement at that point. So for the most part, 120 days is where it's safe. But I also do want to stress on the other side of that, a provider can't just say, maybe send out one bill and then wait 120 days and write it off. It wouldn't be allowed there because the 120 days has to have continuous collection effort within it before you can write something off. So that's just stressing that point. Another point about the bad debt recoveries being reported as a negative in the period of recovery, regardless of what year the underlying bad debt related to, the bad debt recoveries offset bad debts in the year they were recovered. So that's another thing CMS just put into regulation. But there were some slight revisions for certain items, and really a couple of these will help, I believe, providers. One of them, probably the biggest one that'll help providers, is the timely billing requirement. In other words, how soon do you have to bill the patient in order for it to be considered valid collection effort? Just as an extreme example, if you wait a year or two to bill a patient, that doesn't make any sense because that patient probably won't take that, or may not take it seriously. I shouldn't say probably. They may not take that seriously if they owed somebody that has not billed them for 2 years that apparently doesn't look too important. So that's one thing that could come up. Of course, there's always risk the patient's financial status or their situation could change within that period of time. So it just makes a lot more sense to bill rather quickly so the patient knows exactly which service that was for. They can take it seriously. They can make payment if they can. So up till now, it's basically been a requirement that the bill be issued shortly on or shortly after discharge. But there's been really no hard set requirement. Different MACs have set different time frames. Now CMS has come out and said they're going to allow up to 120 days after the Medicare RA date, or if there's a secondary payer like Medicaid or another insurance company, then it would be 120 days after that later secondary RA date or the denial from that secondary payer. So this gives you quite a bit more time, a lot more leeway than a lot of the other MAC standards have been, including ours. But again, keep in mind that's prospective effective date for that being locked in. The other thing that they made a slight change to, not necessarily a favorable change for providers. It's not unfavorable, but it's not really favorable. This was the indigence documentation. There have been a few appeals over the years on this issue. CMS has stated in the past that their policy states that we must, or providers must review assets, revenues, liabilities, and expenses before they determine a patient to be indigent as far as bad debt reporting. This new change basically says, yes, assets and revenues both are still required, but liabilities and expenses really don't serve a whole lot of a purpose, because that would, if anything, that would make it more likely that the patient would be written off for bad debt. So there's just not that risk there with liabilities and expenses. But they did stick to their guns and say that both the assets and the revenues must be required, instead of just looking at revenue, which is what a lot of providers in some of those appeals had done. So now it is in regulation that way. They did also clarify that presumptive eligibility is not allowable for bad debts, for Medicare bad debts. They also reiterated the must-bill policy that's been around since 2004, but they did offer a few slight alternatives. If you're in a state that does not issue remittance advices for your specific type of provider, so it doesn't cover all provider types, it's just those that don't get remittance advices in your state. In that situation, you can submit a state Medicaid notification saying this. By the way, these are all, it has to be all three of these. State Medicaid notification that this is the case, the documentation from the state regarding what liability they may or may not have, and documentation from the state verifying that patient's Medicaid eligibility. If you can submit those three things for states that do not otherwise issue RAs, then you can be allowed as an alternative to the must-bill policy. But for the vast majority of other provider types, the must-bill policy still stands and is now in regulation. The big change here that I wanted to spend just a brief amount of time on is a policy that a lot of providers have asked about because of a change to generally accepted accounting principles, GAAP, that took place. It was going to be effective for the first, basically, public companies, publicly traded companies. It was effective for financial statement periods beginning in 2018. So those provider types, corporate providers, publicly traded companies, have already seen this change on the GAAP side. There was never really any sort of change on the Medicare side until now. Now, the good news is, though, that this change that I'm about to talk about for non-publicly traded companies, including not-for-profits, this has actually been deferred. This GAAP change that I'll reference here has been deferred until fiscal year beginnings on or after 12/15 of 21. So I kind of spoke about this out of order. I gave you the dates before I give you the substance. This is Accounting Standards Codification 606 that really completely overhauled how bad debts are now treated on the financial statement side. In the past, for years, since really the beginning, bad debts were treated as an expense, which of course offsets revenue to give us a net income figure. But the point is, there's a clear revenue, there's a clear expense, and then there's net income. This codification standard change now basically says these are no longer expenses. If you have any way of estimating that a certain amount is not going to be paid, that should never have really been counted as revenue to begin with. It should be considered an implicit price concession. That's the phrase they use. So it's a contra revenue. It offsets revenue directly instead of being treated as an expense later on. So it's all about how it's reported. It's no longer going to be an expense. It's going to be an offset directly to revenue. And the problem is there was nothing in Medicare policy that allowed that. Medicare policy had always said it must have been written off to a bad debt expense account at some point. Of course, it would be an allowance. It would be an estimate at that time when the expense occurred. And then later on, you'd have the specific patient written off. But due to that phrasing, that expense requirement in the policy, this was kind of a bad situation because GAAP was requiring one thing and Medicare standards were requiring a different thing, and they're really completely irreconcilable. You cannot do both. There's just no way to do it. And the reason I say that is that if you tried following GAAP, for example, you record it as a contra revenue, but then you do some sort of after the fact adjustment to bring that back to an expense to meet Medicare requirements, that's a situation that wouldn't really be proper to begin with. So that's the only concern there, is it wouldn't be proper from the gap side, first of all. And yeah, we understand that you were doing it to try to meet Medicare policies. And that's something we brought up to CMS for actually a number of years now, since this standard codification first came out. They're finally addressing it. But the unfortunate part is that it's prospective for basically 10/1/20 and after, because that's the final rule. That's when the regulations take place. Now, so I guess the point here is, fortunately for some provider types, the non-public companies, the not-for-profits, it's not going to be an issue because your gap change has not taken place yet. It's been deferred until 21, so that'll work perfectly. But obviously we have quite a few publicly traded company providers, and that's where we have an issue. We brought this up to CMS. We've said, hey, this still doesn't fully address it. So we are working with them. We're trying to figure out what does this mean? How do we handle it? It's irreconcilable. So what can we do about it? We don't have any clear answer yet. We're going to bring it up in the next, what we call the technical conference we have with CMS and other MACs. We're going to see what their point is, or what their view is. But ultimately, this is something, I mean, providers are following what they have to for gap. So, how do we handle that in Medicare? We have to have a way of handling that. So more to come for that. But I do want to point out this last sub-bullet point here that CMS stressed in that Federal Register. The write-off to a contractual allowance account is still not allowable. Although that's also a contra revenue account, it's also a revenue offset. The difference is that with a contractual allowance, there was never any legal entitlement to that money to begin with, whereas with an implicit price concession, you were legally entitled to that, but you realize you're probably not going to collect it. It's just not a collectible item. It's a bad debt. So that's the difference. CMS did stress that if it's written off to contractual allowance, that's still not going to be allowable. So I just wanted to point that out. They've held to their guns on that. So that was the bad debt topic. And yeah, good point. There's another question on that 606. And you're right. Even though I said it was deferred for the non-public companies until 12/15/21, what the part I missed there was that if you had already filed your financial statements, then you were bound to it. So even if you're not for profit or a non-public company, you're still bound to it at that point. It was the deferral was only for providers that had not yet filed their financial statements. So the question here was that 606 has already been adopted by several hospitals. And of course, yeah, some hospitals aren't subject to FASB at all, governmental hospitals, so they follow GASB instead. And yeah, we're definitely aware that, yeah, CMS has not quite fixed this for all entities. So all these things we're trying to bring up to CMS because ultimately it's irreconcilable. Something needs to be done, and it really can't just be prospective because that won't catch everything. It needs to be, to some extent, retrospective or retroactive as well. So we're just trying to figure out, what are they going to do with it? Is it something are they going to just amend how MACs review it, or that we don't review it? It's not a concern. It's up to CMS ultimately, but we're certainly bringing these things up to them. So good question there. Thank you. Just a quick discussion here with the RHC productivity standards. I think I missed one. So we have a website article and a corresponding checklist and even a YouTube video on this topic. Basically, it explains how to qualify for these RHC productivity standards if you're unable to meet the minimum number of visits for your number of FTEs. There was a change, though, recently, again, due to COVID. As you can imagine, a lot of RHCs are in a situation where the patient count is just dropping. Certainly hospitals in some areas, they're seeing increased patient counts for COVID-type patients, but they're seeing a decrease in some of the other patient types. And RHCs are hit pretty disproportionately on these because, again, a lot of people are not necessarily going in for the treatment they might have otherwise. They don't want to be out in public necessarily. That's the idea. That's the concern. So CMS is aware of this, and they did issue a statement that Max should take this into consideration when reviewing these productivity standards. They didn't tell us any sort of specific form to use or any sort of other guidelines. They just said it's still subject to the Max discretion, but we should consider it. So we still have the same checklist that's linked here that you can use just to communicate your request, the name, number of the RHCs. And the only difference here is for the justification, which is actually number 4, really just explain that it's a COVID request and just explain what's going on in your facility, maybe some percentages of visit drops you're seeing. And that's really what we're looking for there to review those. And I do want to mention, as you can imagine, we're seeing a significant increase in these types of requests, well beyond what we received for the normal RHC productivity standards. There's no specific time frame either for the providers or for Max to review them. We're trying to get through these as quickly as possible, but they're not going to be turned around immediately. Usually we've set an internal standard of about 60 days, and a lot of these are butting up right against that. So just keep in mind, we're logging them, we're shifting through our different workloads, and then we come back and we do these in batches, the RHC productivity standards. So feel free to send those in. If you have any, they go to the audit advisement email address that was listed earlier. And now one that I wanted to spend a few minutes on was the CR 11642, the GME Nursing and Allied Health Managed Care changes. The first thing I want to mention is this was issued August 21st, and it's only applicable for either cost reports that are now open, and of course all future cost reports, or those that could still be reopened. If they're appealed for this specific issue, if they're within 3 years of the last NPR, then we can reopen it, and in fact, we have reopened it. These are MAC-initiated reopenings, so you don't even need to worry about it. You should have already received the reopening request. And then we take a look at some more information about this. Basically, the whole purpose of that CR was to update managed care pool numbers that had not been updated since 2001. So this CR updates them from 2002 through 2018. But again, it's only applicable for providers that can actually be reopened. We can't go all the way back to 2002 unless for some reason that cost report can still be reopened. So this impacted 2 different things. The GME Medicare Advantage payment reduction, that's built into the cost report, so there's no separate calculation. It was changed, though. They added a new line 29.01 to E-4. To get that to work, you have to answer S-2 line 556 column 2 as a Y, and that'll apply the new reduction factors. Otherwise, it'll keep with the old 14.13 factor. But the other change that'll open up at that point is that it'll require a PSNR split at 12/31 for those managed care days. And you'll see the 2 columns there because, again, every calendar year has its own reduction factor. The big change, though, was the Nursing and Allied Health HMO add-on payment, which is an off-cost report calculation. The thing we just recently, in fact, yesterday, we updated our website with a reference to a calculation form, and it also has a YouTube video that's been created with this. So I want to show you that just briefly. It's found under the Nursing and Allied Health section. It's actually this first article. This is the new article linking you to the YouTube. It links you to both the new change request as well as the original change request that updated the 2001 factor. It was issued in 2003. But what I want to point out here, this screenshot, in the YouTube video, we say the form will be linked here, and it will be very soon. But right now, if you go out there, it says to obtain a copy of this form, please send an email to Audit Advisement. We had some last-minute changes we needed to make for ADA compliance. Those have now been made, and the website will be updated again with that form in the next, well, probably by next week. But if you need something in the meantime, feel free to send me an email to this address and I'll send it out to you. And it just goes through a lot of the detail that I've just discussed, the rest of this website article, as well as the YouTube. This is the attachment from CR 11642 talking about, well, first of all, the far right column is the new percentage reduction. The pool number that these payments are made out of, these nursing and allied health add-on payments, this is the first number here. And then this second to the last column, that's the total national nursing and allied health cost amount that's used as part of this calculation. These middle three columns are just part of this second to last column. That's how this was derived. Our template highlights the information that you need, and again, it builds that in there. And I think since we have just a couple minutes, I do want to just briefly bring that up if I can log back in here. Actually, I think I might have it over here. Let's do that. Open this up, and I'm just going to briefly show you a couple things. This is the form that you'll see. There's an 88 tab at the very end. If you need that, that's all you'll need. But if you want to use the automated version, there's an input tab. It'll help you select the years in question. Those of you that have done this calculation before know that the year selection is a little bit convoluted the way they've defined it, but this helps you to do that. Again, you can input the cost report data, and it'll all flow over to this final payment amount for each year. It'll add up year one and year two if it's applicable. And here's what I was talking about with the CR attachment. We highlight the information you need, but it's already pulled in by these calculations. So again, just that's all discussed in much more detail in the YouTube video. I just wanted to take a minute to show you that. And I see we have a couple of questions out here. Let's see. So the RHC productivity standards. Yeah, we could take a look at that once we log them. But the key thing is we've been doing it in batch, so it's not we don't do it every single day. We'll respond that we've received it, but with all the other different workloads going on right now, we've got to kind of batch it. We do one batch of those, then we turn on to S10, we turn on to some other things. But I am going to be getting to another batch here probably Friday and through the next week. So a lot of those will be taken care of. And the ranking, I'll definitely make sure to do that. So that way we rank them by year end. And we have a question on the letters. So yeah, basically if your NPR date was within 3 years, then it's already been reopened. If you do have a question though, and you want to find out about that, you can send an email to Audit Advisement, that email address, and I can respond with the actual letter as well. It went out via mail. I think it was the 8th perhaps. Oh no, it was last month. I forget the exact date now, but they've been out there for a while, so I can certainly send you a PDF copy of it as well. Yeah, I think it was 9/18. Now that I'm thinking about it, is when those were sent out. So feel free to shoot me an email if you have a question on that. And then the last topic we had here was the EHR, what's now known as promoting interoperability, the payment reductions. I know we only have a couple of minutes, but I just wanted to point out that this payment reduction applies when either an acute or a critical access hospital does not attest to meaningful use for a certain year, but it's not just that particular year that it applies to. So for example, currently the federal fiscal year 2021 payment adjustments, they're based on how you attested in your 2019 reporting period. And we have a link to the EHR portion of the CMS website that discusses this. So we get a lot of provider questions on this because they don't think maybe they should have been subjected to that. I think when I looked at the log just recently, there were maybe 100 and some providers that are subject to this. For critical access hospitals, it reduces you from 101% down to 100% of the cost for payments. And for acute care hospitals, it impacts the market basket update factor. So it's an important thing, could have a big impact. Here's an excerpt of the current from the CMS website, the tables from the final rule. And this just shows you, it's one of the last columns. It shows the proxy EHR reduction. And in this case, this one provider happened to have a 1 there. Again, there are about 130, something like that, that were included in this. So if you're there on the 10-1 rule, then it will be subject to the EHR reduction. Now, there are potentially retroactive changes due, first of all, to appeals. If you appeal that meaningful use status and you win, then that could be a retroactive change. And in some cases, hardship exception requests that are approved could require a retroactive change. CMS sends us updates to those. Usually monthly. They were supposed to be sending those monthly. Sometimes it takes a little bit longer to get those. But ultimately, what I wanted to point out is this is up to CMS. So if you have documentation that shows that you don't believe you should have been subject to the reduction, feel free to send it on to that email address and we can forward it to CMS for review. I will say, though, their response to that particular issue, their research, it takes a little bit of time sometimes. But when they do give us the response, by the way, they have to do it through the system. So they have to send a system response to update the system, the FIS system for claims processing. For acute care hospitals, it requires us to reprocess claims, which we certainly do. For critical access hospitals, it's just handled at desk review or possibly reopening. So I know I went about a minute over the normal time, but still, if any questions, if you have any, feel free to ask any right now. I'll stay on for as long as I need. But for those of you that want to jump off, thank you for your time today. This will be recorded, or this was recorded, I guess. So I'll be posting the recording on our website. I'll send more information out about that. And thank you all for your time there. I'll just stay on and see if anybody has any other questions.